If you're looking to invest super long term and you want to make serious money, this series is for you. Today we'll be covering part 2, which is number 11 to number 14 of this top 20 stocks to hold for 20 years. Number 11 is going to shock you. It's a company that's done a 20-for-1 stock split, and they are actually having a product which you are using right now. I can prove it to you. So if you don't believe, continue watching on. Hi guys, welcome back. This is part 2 of the series, and just to recap things a bit, let me run through the criteria as to how I've actually came up with each and every name and rank them. Because when it comes to ranking, we must have a certain set of priorities. Everybody's rank can be different, but let me show you what my key criteria are. The first is the company must have a long history and must be managed by already a successor. I'm not looking to put names here right now that are still founder driven. I'm looking for one whereby someone can come in and continue the business running as usual. Because we're trying to invest for 20 years. Then, in terms of priority, I'm preferring non-tech over tech names. And more than that, I'm also preferring companies who are paying dividends. And many have coined this term dividend aristocrat, which means they are paying dividends consistently and with a growth to that dividend also. So if you're curious about more criteria, check out the first series. I'll leave it towards the end of this tutorial also. Now, let me show you who's number 14 on today's list. By the way, number 15 is actually Abbott Laboratories. Abbott actually produces products which you may have used also, but number 14 is also in this science space. It also produces something that you probably have used very recently. It is none other than Pfizer. Pfizer is founded in 1950s. It's one of the first to produce a COVID-19 vaccine. So you may have used Pfizer's vaccine also. But Pfizer does more than vaccination. It produces medicines, it produces drugs. The bulk of its revenue comes from its biopharma business, and it has more than 18,000 patents. Wow. So as you know, life sciences, you can't create something out of thin air. You don't need to go through a whole process. It's not so easy for someone to disrupt you. That's why it's sitting high on this list of 20 companies who invest for 20 years. Because for a company to come into the space, it needs to have a track record and they need to know how to do this patent process. Then more than that, Pfizer has actually impacted more than 1.4 billion patients with its medicines and vaccines. This is hugely impressive. So if you are thinking you are using only Google's product, for example, then Pfizer is definitely also something that you are also using because it's impacted 1 in 5 humans on this planet. So why I rank Pfizer so highly is because it's actually been a very consistent dividend payer. If it's not for the 2009 acquisition of Wave for $68 billion where it required to cut dividends, if not you'll be bleeding too much of cash, Pfizer has actually been on a steady graph of paying more and more dividends per year. And if we say in terms of performance right now for Pfizer on this chart, you realize that it's actually done well in the last few years, correct? And the price earnings ratio right now stands at only 8.43 times. Now this is very cheap, but my concern is also, could earnings have peaked in the near term? Because for COVID, there's a lot of vaccination revenue, correct? So if earnings have peaked, that could be reflected in the low price earnings multiple. So keep track of this company. If it corrects significantly, I do think it's a good company to pick up and own for the long term. Moving to number 13 on today's list is Caterpillar. You may have seen Caterpillar's machines if you go past a construction site or mining site. Caterpillar is one of the oldest companies around. They are founded in 1925, and my belief is that if we were to do space travel and stuff, I think mining equipment is still going to be used, correct? We're not going to just rely on spatial material. We are definitely going to still require some machines to be moved to outer space also, and you can bet that Caterpillar would definitely be one of them supplying machines to move to outer space. In terms of its annual dividend, this is a good chart to show you how consistent they have been. Not just that, you realize also the dividend has been growing, reflecting a stronger and stronger earnings per share. In terms of the price chart, you realize that Caterpillar has also been a very consistent performer. Probably a bit more lumpy than many companies because in terms of building and construction, it goes through cycles. Once a recession comes like in 2008, you realize that construction slows down, development slows down, infrastructure projects are done less. That's why this company can go through cycles. So if we are seeing a recession right now, it's quite possible that this company would see a lower valuation. But it also depends. If you're looking for 20 years, then it could also represent a buying opportunity. In terms of price to book ratio wise, you can see that it's pretty fair in terms of 5-year average. So I do think the trick to investing in Caterpillar is to find the right economic cycle to get invested into, especially when the world recovers from recession and we're starting to do more infrastructure projects. You should expect Caterpillar sales to start picking up. Number 12 on today's list is a company who you probably have drank their products before. I'm sure you have done actually. It is none other than Pepsico. Pepsi is one of the biggest brands in the world when it comes to beverage, correct? Obviously, its other competitor sits atop the top 10, and it's none other than Coca-Cola. Later, I'll explain a bit more as to why I rank Pepsico so high, as well as slightly below Coca-Cola in some ways. In terms of its annual dividend, you realize that PepsiCo has also been a steady dividend payer. On average, it's increased its annual dividends by 7%, and this chart actually shows 50 consecutive annual dividend per share increments. Wow. So if you have been an investor in PepsiCo, you have collected $1.89, but 10 years after that, that dividend has doubled. So if it doubles every 10 years, wow, you could get a much bigger dividend if you're looking to invest for the super long term. Why I rank PepsiCo so highly is because in terms of the beverage product, we are very unlikely to change our consumption habits. In fact, if there's a new beverage brand that is emerging, you can bet that either Coca-Cola or PepsiCo would buy it up. 2 weeks later from now, you're still going to drink Pepsi. 2 years later, you're still going to drink Pepsi. 20 years later, I would also think so. That is why maybe this has explained PepsiCo's strong share price performance ever since 2008. You can see it's been a gradual slope all the way up, correct? Fantastic share price performance, slow and steady, and I hate to say it, this could be really as safe as it gets when it comes to investing into equities. The downtrend is very minor, which means if there's a global recession coming in, it only represents a buying opportunity because this company is going nowhere. I would also dare say that this is more stable than any of the tech giants that come to your mind. It can be Apple, it can be Samsung, but 20 years later, we really don't know what kind of products we'll be using. But Pepsi, I'm pretty sure everybody will still be drinking them. If you see in terms of the recent share price performance, in any case, if you're curious about this platform that I'm showing you right now, this is actually from Webull, who is today's proud sponsor. Now, Webull is a platform you can actually buy US stocks. And with a simple click of a button, you can see the charts, you can see newsfeed, and you can see analytical tools. Over here, you can actually see that PepsiCo has actually beaten earnings per share estimates over the last 3 quarters. This function is even more important for companies whose earnings may fluctuate even more than PepsiCo. And if you're new to Webull, do use my links below to sign up because right now they have a new offer giving you Tesla shares worth almost $130. And we'll run back to our list. If we were to compare PepsiCo and Coca-Cola, you realize that PepsiCo is even more stable in terms of share price than Coca-Cola. But in my opinion, Coca-Cola is the stronger brand. Maybe it's personal biases. But in any case, in terms of investment-wise, I still rate PepsiCo highly. And let me know in the comment sections whether you are a Coca-Cola fan or Pepsi fan. With that, let's move on to number 11 on today's list, who is someone I promise you that you're actually using a product right now. And that's because you're watching this on YouTube. The owner of YouTube is none other than Alphabet, who also owns Google. Now, I know what you're thinking. Why is Google or Alphabet so low on this list where many people will gladly put them in the top 5? My reason is quite simple. If you look at this over here, you realize that YouTube is highly used amongst many US teens. However, you realize that this trend can actually change over time. Facebook, for example, has been caught on the wrong side of this trend. We don't know 20 years later whether YouTube will still be relevant. We don't know 20 years later whether Google will still be the dominant search engine or not. As of right now, Google's advertisements across its platforms, including YouTube, is its main revenue source. That's something you need to take note. This is very stable and it's likely going to stay that way for at least the next few years. But 20 years, things could possibly change, especially with blockchain technology, for example. The other strong point about Google is Google Cloud. This is a business segment that is growing steadily. And who knows, maybe like AWS, it could become the key contributor in the future. As of now, Google does not pay a dividend, and you see that share price has corrected quite severely, especially for 2022. Whether you view it as an opportunity or not, let's look at some numbers. Earnings per share seems to be deteriorating in the last few quarters. That could be due to the recession because companies are cutting back on advertisement budgets. Google has actually missed its earnings per share, unlike PepsiCo. So this is something to note and it explains why share price has corrected. But this again could be a temporary drop. In my eyes, Google is not going anywhere. It's just that in terms of price earnings ratio rise at 19 times, it could possibly come down a bit more to the pre-pandemic levels, and it's something that I'll watch out for. Again, anything mentioned over here is not financial advice, it's not a buy or sell recommendation. It's just purely my opinion on the share price as well as the company for the next 20 years. And as always, if you like these charts, you like these analytical tools, check out our sponsor today, Webull again. I'll leave links below. And with that, I'd like to round up today's list. This is what I've covered in the previous tutorial, number 20 to number 15. And for today, we've covered number 14, Pfizer, number 13, Caterpillar, number 12, Pepsico, and number 11, Alphabet, which owns Google. So let me know your thoughts in the comment sections. Smash the subscribe because in the next episode, I'll be covering who's in the top 10. Take a guess where Amazon sits, take a guess where Apple sits, and press the notification bell so that when that tutorial comes up, you get notified of that. With that, I'll sign off from here. Check out the previous list also, and I'll see you there too. Take care as always. Goodbye.